Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day.
इस बार मनाली चलते हैं।
नहीं गोवा।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI is the banker to every Indian.
A sudden jump in COVID-19 cases has forced China to impose lockdown in at least 13 cities. One of them, Shenzhen, better known as China's Silicon Valley, is a hub for manufacturing electronic goods, including chips. Our next report tells about the impact it will have on Indian smartphone manufacturing.
China is experiencing its worst wave of coronavirus since early 2020, when the first wave of the pandemic emerged in Wuhan. The country has locked down more than 45 million people across multiple cities amid 5,154 fresh cases on Tuesday, compared with less than 100 a month ago. One of the cities under lockdown is the technology hub of Shenzhen, where authorities have ordered non-essential businesses to close at least until March 20th. The city has a population of 17.5 million. Dozens of companies that make everything from printed circuit boards to touch panels, many of which are Taiwanese, have stopped production at their factories in Shenzhen. Contract manufacturer Foxconn, which is the biggest iPhone assembler, resumed partial operations at its two Shenzhen campuses after 2 days under a strict factory bubble system. Shenzhen is known for its hardware manufacturing ecosystem. It also has the world's fourth largest container port. Although all smartphones that are sold in India are assembled locally, handset manufacturers still rely on imports from Shenzhen for various vital components. In fact, India's biggest import from China is electronic components. Of the total imports of $76.6 billion from China between April and January of the current fiscal, electronic components accounted for $8.8 billion. Apple's second largest supplier, Pegatron, is reportedly aiming to start local production in India next month. But potential supply chain issues could put a spanner in the works for the contract manufacturer. Navkendar Singh of IDC India tells us whether the Shenzhen lockdown is a cause for worry for India.
Even after lots of activity around make in India or assemble in India, we're still highly dependent on China, especially Shenzhen. The reason for that is while lots of ecosystem of production has been developed in India around the lower value items, which go, lower value components like charger, battery cases, but the higher value items like display and the chipset, they still we depend on China, right? So and Taiwan to some extent. There has been a problem with the supply for the past 2 years, and normalcy was returning. But then two things happened, right? After the mid of February, we saw Russia, both countries which are very important in some of the raw materials which are used in the component production in China and some other parts of the world. And the double whammy on that is another set of cases coming in. China has been very ultra cautious in the sense, since the first wave, they know that the world depends on the value chain which comes out of China. And you can't have disruption going on more than 15, 20 days. Our view is this on this particular Shenzhen piece. See, Q1 is sorted from supply and a production in India point of view. Q1 is okay because lots of brands, and I'm talking across categories now, TVs as well, and this as well, and some of the laptop guys as well. Now, if this goes on beyond 20 days, this Shenzhen lockdown and some of the other ports lockdown, then it's a matter of concern for us. Then we are staring at a possibility that May mid onward, the latter half of the second quarter, and depending on the severity of this and how long it can go, maybe the third quarter as well, we should see some impact coming there. Even this 20 days will lead to price hikes as well. The stocks are not there even for the components you need. You would bring them by air freight probably, which is very expensive. Only 5 to 10% of the components are brought by air freight. Everything else is by shipping lanes. So if the ports are not there, then how do you bring it?
Apart from electronic components, India's top imports from China are telecom instruments, computer hardware, chemicals, and pharmaceutical raw materials. 70% of India's active pharmaceutical ingredient requirement is met through China. The new wave is testing China's zero COVID strategy, which aims to suppress contagion as quickly as possible with snap lockdowns, mass testing, and careful contact tracing. Indian manufacturers maintain sufficient stocks that can withstand any short-term supply issues. However, if China is not able to bring the current surge of cases under control, the lockdowns could spread to other parts of the country, leaving India vulnerable to supply shocks. Indian factories will face a shortage of key raw materials that can disrupt production, especially in sectors like smartphones, electronics, and pharma.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
From the dwindling chip supply, let us shift our focus to the dwindling returns of Employees Provident Fund Organization. The world's largest social security organization recently slashed the interest rate on EPF from 8.5 to 8.1% for 2021-22. This is the lowest rate in more than 4 decades. But hold on, it still holds the edge. Our next report tells us why.
The interest rates within the economy are at much lower levels. Long-term government securities maturing in 2061 offer a coupon of around 6.95% currently. The Employees Provident Fund also makes a small allocation to equities, which is about 15% of incremental flows. So, the reduction in EPFO's rate of return was inevitable, and this trend towards lower rates may continue in the future. However, EPF's 8.1% return continues to be attractive. Its rate of return on the tax-free portion is higher than what other fixed income alternatives are offering. Remember that there are two components to the return from EPF. Contributions of up to Rs 2.5 lakh are tax-free. Contributions above Rs 2.5 lakh are taxed at slab rate. The post-tax return would come to around 5.67% for someone in the 30% tax bracket, around 6.48% for someone in the 20% tax bracket, and 7.7% for someone in the 5% tax bracket. For an apple-to-apple comparison, we should compare the returns from EPF with other government-backed instruments which give a guaranteed and safe return and can be used during the accumulation phase for retirement planning. The nearest such instrument is the Public Provident Fund, which offers 7.1% tax-free. This is much lower than the return on the tax-free component of EPF. Another instrument is the RBI's floating rate bond, which offers 7.15%, but this is taxable at slab rate. The National Pension System, a retirement saving product, is not a comparable instrument. It is government-backed but offers market-linked returns. Another option is Sukanya Samriddhi Yojana. It is a government-backed instrument which can be used for long-term savings. It offers 7.6% rate of return, which is tax-free. But this is available only to people who have a girl child. Products like Senior Citizens Savings Scheme and Prime Minister via Vandana Yojana offer 7.4% return. But these are taxable. Moreover, these instruments are meant for income generation and not for the accumulation phase. Debt mutual funds are tax efficient, but they are not government backed and their returns are market linked. Yield to maturity for most debt fund categories are in the 5.5 to 6% range currently. Don't change your investment strategy just because EPF's rate of return has been reduced by 40 basis points. EPF has one shortcoming. It is predominantly a debt instrument. If your retirement is a long time away, you should primarily have equities in your retirement portfolio. You could use the NPS where you can allocate up to 75% to equities, provided your risk appetite allows this. You can also use active and passive equity mutual funds. While equities can be volatile in the short term, they offer better returns than fixed income instruments over the long term. In a retirement portfolio, you would want some, say 10 or 20% allocation to fixed income instruments. EPF and PPF should constitute that portion of your retirement portfolio. Avoid the mistake of over-allocating to EPF just because it is government-backed and completely safe. If you do so, you will not have adequate money left to invest in equities, which is the ideal asset class that can beat inflation and help you retire with a hefty corpus.
क्या हाल?
मत पूछ यार,
फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Meanwhile, investors in India are worried about a possible interest rate hike by the US Central Bank today, which is under pressure to cap inflation. Most experts believe that a 25 basis point hike is already penciled in. So will the markets look for cues elsewhere and chart out their course? We find out in our next segment.
The US Federal Reserve announced its monetary policy after a two-day meet post-Indian market hours on Wednesday. The development comes at a time when war clouds over Russia and Ukraine have intensified and impacted several key commodity prices, especially that of crude oil. The US has been battling a spike in inflation that hit 7.9% in February, a four-decade high. The consumer price index has not been the highest since January 1982, when it hit 8.4% amid a recession. In this backdrop, most analysts expect the US Central Bank to hike aggressively over the next few months and see up to 7 hikes in 2022, starting with a 25 basis point hike in March. Markets, they said, are pricing this in at the current levels. Aaron Captain of investment bank UBS expects US Fed to start hiking rates by 25 BPS increments in March at every meeting until November this year, before taking a pause. So will this aggressive US central bank policy action weigh heavily on the global equity markets amid the geopolitical concerns, and how is India likely to perform? Here's a bit of history. In 2017 and 2018, the US Fed opted for aggressive rate hikes. If we look at the performance of US indices for the cumulative period of 2017 and 2018, when the rate hike was 175 basis points, the US equity market still ended a winner. Analysts believe a strong US and global economy matters most for markets to stay buoyant. The rate hikes could bring in volatility with some downward bias, but it will not create any major fall in the Indian equity markets, says G. Chokalingam of Economics Research. But this time is a bit different. The geopolitical tensions have spilled over the heightened inflation, with Brent crude oil prices soaring to over $140 a barrel. Though they have cooled off since then to $100 a barrel, the inflation risk still remains. With the European Central Bank ready to wind down asset purchases sooner than expected and global central banks set to hike interest rates, can India afford to be the lone wolf in the pack? Here's what Devanshu Datta, an independent market analyst, says on whether the RBI will follow its peers in hiking rates and the impact this move can have on the Indian markets.
The impact on India is likely to be negative regardless of what the Fed does, because Indian macros have obviously been affected pretty badly. We are an energy deficient nation. We have to import fuels no matter what they cost. And inflation is a fairly serious problem now, because of also not just because of fuels, but also because of supply chain disruptions. And if the Fed raises rates, I think the RBI will be more or less forced to raise rates in order to protect the rupee. It can't really let the rupee free fall, because then your trade deficit goes out of control. There's already a run on reserves. India has plenty of reserves, but a lot of those reserves consist of hot money, which is coming through the FPI route, and the FPI's selling has been consistent and continuous for a period of many months now.
The market will remain closed on Friday on account of Holi.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Let us now move on from the market's uncertain territory, take a pause and imagine a world without internet. The very thought of it may make you anxious. But the entire population of a remote Pacific island nation, Tonga, went offline for over a month beginning this year. A tsunami had snapped the submarine cables cutting the nation from the rest of the world. So what exactly are these undersea fiber cables and why they have become the backbone of connectivity? Watch our next report to know more.
The transmission quality of a submarine cable is significantly better than the one offered through satellites. Submarine cables are only a few inches thick and they carry only a few optical fibers. Yet, they have transmission capacities of the order of terabits per second. These undersea cables provide vital international telecommunication links between countries across the world, and there is no effective substitute available. In August 2020, Prime Minister Narendra Modi launched the 2,300 km long submarine optical fiber cable connecting Andaman and Nicobar Islands to the mainland. This has brought high-speed broadband connectivity to the islands. These cables terminate in the country through cable landing stations. Access to submarine cable landing stations is an essential input for telecommunication services, including broadband, requiring international connectivity. A submarine cable system consists of a communication cable laid on the seabed between cable landing stations on the land to carry telecommunication signals across stretches of ocean. They generally use optical fiber cables to carry international traffic. They offer highly secure, reliable, and very high-capacity telecommunication links between countries across the world. However, a typical multi-terabit transoceanic submarine cable system costs several $100 million to construct. There are more than a dozen submarine cable systems that connect India to the world. In September last year, Facebook announced that its subsea cable project to Africa, which it is building in partnership with several telecom companies, will become the longest subsea cable system ever deployed. The To Africa Consortium announced the addition of a new segment called the To Africa Pearls branch, extending to the Arabian Gulf, India and Pakistan. This extension will bring the total length of the cable system to over 45,000 kilometers. To Africa will provide connectivity to 3 billion people, or 36% of the global population. It will connect 19 countries in Africa and 33 in total. The system has a total of 27 landings in Africa and 46 in total. It will surpass the current record set by CME-V3 cable system, which is owned by 92 telecom companies and stretches 39,000 kilometers, connecting 33 countries across 4 continents: Europe, Africa, Asia and Australia.
इसको 30 डिग्रीज कर देते हैं। अरे नहीं यार, 45 डिग्री सही है।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का वीडियो KYC सेविंग्स अकाउंट। Finally I agree.
SBI is the banker to every Indian.
The web of these fiber cables crisscrossing deep seas and oceans have indeed turned the world flat, thousands of years after Greeks had declared it round. That's all for today. For more news and analysis, please log on to businessstandard.com. We'll be back tomorrow with the next episode. Thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.